Welcome, everyone. Today we are diving into the world of investment risk. I'm Scott, and I'm an Ontario Securities Commission licensed portfolio manager, which makes me a fiduciary, somewhat distinct from your average bank advisor. Well, risk is everywhere in our lives, and the world seems to be getting riskier every day. In this series of quick videos, we'll explore different types of investment risks, including market, credit, and liquidity risks. Many don't fully grasp the risks to their wealth in their investment portfolio. Understanding complex ideas like market moves and standard deviation are factors that impact your assets, your portfolio, and your wealth. Understanding these risks is the key to smart investing. Let's dive in and make sense of it together, starting with the basics of risk and how it shapes your investment choices. Today, we'll talk about market risk, while in the next series, we can explore credit and liquidity risk. And armed with this knowledge, you will be better armed to navigate the investment landscape. Remember, the goal isn't to avoid risk, but to understand and manage it wisely and seek out those who can build the appropriate strategy to get the best possible risk-adjusted returns. Stay tuned as we break down these concepts to help you become a more informed investor. So imagine seeing your $1 million portfolio take a sudden hit, dropping by, say, $160,000 in just a few short weeks. This slide on display is an example, approximately 16% lower. This is about a one standard deviation move for the S&P 500 and its correlated markets. And we all know that when the S&P 500 falls 16%, most other global stock markets will panic similarly, which is exactly what occurred in March and April of this year. While someone with a more balanced portfolio, with an asset mix of less correlated assets, meaning that their investments don't all react the same way to market shifts, and potentially cushioning the blow, suffered a significantly smaller loss thanks to a more diversified approach. And more importantly, recovered very quickly, getting back to better growth faster. Will you sleep better at night with less of an impact on your portfolio and not counting on hope to bring it back to growth, removing the scare and emotion that might cause you to panic, especially in these challenging times? Do you know what happens in a one standard deviation move in your portfolio? Does your advisor? Going forward with all the potential volatility coming our way in financial markets, will you sleep better and not have to rely on hope? Don't forget, past performance is not a guarantee of future growth, but good risk-managed portfolios will endure, especially over the long term. Thanks for listening.